Welcome to today's edition of The Good, the Bad and the Ugly, especially curated from the world of economy and business today. Let's start with the good again. Now you won't need to share your Aadhaar number with anybody, not even the photocopies. The number and the card have been made truly personal, with the UIDAI making it mandatory for all Aadhaar authenticators to accept virtual ID instead of the actual Aadhaar number. Unlike the 12-digit Aadhaar number, the virtual ID is a 16-digit number which can be used to authenticate your identity without ever submitting an Aadhaar proof itself. The virtual ID can only be generated right now on the portal, but at some point in time, the app will also enable generation of virtual ID. Every authentication requires a new virtual ID to be generated, and that makes it slightly cumbersome, but it's possibly the best solution available to prevent Aadhaar misuse and Aadhaar frauds. That's what makes this good. And now the bad. The latest data from the Department of Industrial Policy and Promotion says that foreign direct investment in India is slowing down to barely 3% growth in 17-18 to $44.85 billion only. This is the lowest growth that India has seen in the past 5 years. And even though this is the highest investment in terms of equity in any of these years, it's not good news for India. Just in the previous year, 16-17, foreign direct investments grew by 8.67%. In the previous 3 years, they grew by 29%, 27% and 9%. The slowing growth is being attributed to an uncertain FDI policy framework. Earlier, an UNCTAD report had also said that India's FDI was only $40 billion in 2017 calendar year as against $44 billion in 2016 calendar. The services sector and the IT sector in total received about $12 billion, followed by telecom and trading at $6 billion and $4 billion respectively. The slowing FDI growth will widen India's current account deficit, will raise domestic inflation, and will put additional pressure on the rupee to weaken further. This is what makes this bad. And now the ugly. Just as the FDI investment is slowing down, there is a double whammy in store for India. In the first half of this year, the foreign portfolio investment, which is the investment into India's debt and equity markets, has seen the biggest flight of capital in the last decade. This will result in an even worse current account deficit because of flight of forex. Since January of this year, foreign portfolio investors have withdrawn 48,000 crore worth of investments from India in debt and equity markets. Almost 85% of this withdrawal has been from the debt markets and about 15% from equity markets. This is a direct impact of India's increasing crude import bill as well as worsening rupee. A weaker rupee reduces the return that foreign investors make in India when they convert their rupee earnings to dollar earnings. This is what is making them exit the Indian market. Besides, the US interest rate hike is an added attraction to take the money from developing countries like India back to the US to invest. Such flight of capital from India is what makes this ugly. If you enjoyed watching this content, please subscribe to the Business Today YouTube channel and also like us on Facebook. Our Facebook page, www.facebook.com/businesstoday. Follow Business Today on Twitter India at BT_India and subscribe to our YouTube channel Business Today India.